In studio with the Admiral Bill Stubblefield.
Good morning again, Rob. Good session with Steve, as always.
New York Times best-selling author John Gilstrap.
Morning.
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 What'd you think of Thurmont?
It's a beautiful town. It's actually all those Maryland towns. Having grown up in Northern Virginia and spending a lot of time coming to know that as Maryland, Montgomery County, that part of which I really can't stand.
Montgomery County's tough.
And then up into Baltimore, and so Eastern Maryland. It's an entirely different state. Western Maryland is just breathtaking. It's gorgeous.
A lot of hills. It's it's basically West Virginia.
West
terrain.
Virginia, exactly.
Yeah,
It really is. And Thurmont's pretty cool too. It's everyone has the same story because you do field trips up around there with kids in school, and inevitably you're hiking around those mountains there, and you will, if you're not careful, run into the outreaches of Camp David. And you'll know when you run into those outreaches of Camp David when the armed personnel greet you and say, you are approaching an area where you shouldn't be. Turn around.
And the other thing about that area is a hidden jewel of history, and that's Fort Ritchie.
Yes.
And if you've not been taking a quick tour through Fort Ritchie, you should. It's
closed during the
history.
BRAC closes, was it not?
It was closed, and it was purchased by I think the city of Hagerstown, and they were going to make some resort. They run out of money and could not do it, and so they sold it. They sold it to a Japanese developer, and the Japanese developer had going to tear everything down and build this resort around it. Fortunately, they ran out of money, so a local venture capitalist that lived in the area bought it, and he lived there as a kid, so he knew it as a child when Fort Ritchie was in its heyday, and he's going to keep it the way it is now with enough amenities built in to make some money. They have a wonderful town center they're utilizing. The old houses they have reconverted for rental. And a lot of people that are renting them lived in there when they were a child. It's a beautiful place with a lot of history, and 60 Minutes has had a couple of series on Fort Ritchie boys, and it's, as I said, it's a gem and a jewel of history.
They did some code breaking during World War II, if I recall.
They did a lot of code breaking. Also, more than that, they trained folks to infiltrate the German, because a lot of them were German nationalists that moved over, a lot of Jewish, and not only infiltrating the Nazis, they also served as grillers, trying to get information, interrogators, and they were very skilled of getting the information from that. They played a key role in the eventual outcome of the war.
Yeah, when my son was 9, my oldest son was 9, and he was playing U10 soccer. They had a soccer match up at Fort Ritchie because I think the Thurmont youth teams were using that as their home field. And it was quite an experience going on to that base the way it was now. Steve Pearson forgot something? He did. You can come in and get it, Steve, if you need to, by the way. Our guest in this segment is Financial Phil McCoy from Ameriprise Financial and the Mirius Group of Financial Advisors, Winchester Avenue, Martinsburg. Good morning, Philly.
Good morning, guys. How are you all?
We are splendid. So before we get into some money talk here, Phil, this is money talk. The Steelers acquired DK Metcalf from Seattle. Signed him to a 5-year, $150 million extension there, Phil. That's an average of $30 million a year by my quick math skills on that one. What do you think?
Well, there's two parts to it. I have mixed emotions. One, I like DK Metcalf, the player. I think that certainly makes them better. If they can hang on to George Pickens, they have two of the top deep threats in the NFL, and you can no longer double George Pickens, and so they should be an explosive offense depending on who they get at quarterback. So I think it does make them better. However, man, that's a big contract for a wide receiver. And I know that there's others out there, but I think that puts him in the top 5 or 6 of wide receiver pay in the NFL. And I don't think he's a top 5 or 6 receiver. But so the money part of it, not crazy about. I'm not used to it as a Steeler fan with the big name free agency signing, but the player, I think he's an incredible player. He's a freak of nature. I mean, guy's 6'4", 50 pounds, and runs like he's 5'6", 150. I mean, the guy's unbelievable. but I don't like the money part of it.
Yeah, and technically it was a trade as opposed to a free agent signing. Technically.
Yes, yeah, you're right. They traded a second-round pick, which could be, that's the other part of it. So, and again, the player himself, I like the player. I think he'll certainly make them better. But man, it's a lot of money.
Is your firm willing to help him manage his newfound?
Yes. yes. If he were to walk through the doors of 1270 Winchester Avenue, I would think that was a tremendous contract. We would
DK, I don't think you're worth this kind of money. Take your money somewhere else. On principle, I will not advise you.
DK, if you're driving through on your path from Seattle to Pittsburgh and you're listening, we do have some professional athletes at one of our offices, quite a few of them, actually. So we've got experience with it, DK. Come on by, buddy.
I think you guys have some NBA players. You got a bit of NBA.
We do, yeah, we do. We've got one of our offices down south, and not out of here in Martinsburg, but we do. We have a handful of highly compensated professional athletes, which is kind of cool.
Very nice. Let's talk, speaking of formerly highly compensated, Admiral Bill Stubblefield. Each day he comes in, he cries just a little bit more.
It has a lot of big crocodile tears going these days.
I
need help.
I was getting some serious grief for selling Tesla at $150, and right now it's at $253, Phil. And it's still $100 above where I sold it, but it's coming a lot closer back to me than it is up where Bill was at $488.
$488. That's quite a shock value there, Phil.
Is Rob tends to get enjoyment out of it. Like
no.
It drop.
Yeah,
getting pleasure out of your pain.
Yeah, you were lamenting a few months ago, how Rob took advantage of your lawn, your garden, everything else, and I was sitting back just kind of smirking. Not anymore, Phil. I'm on your side, buddy. He is coming after me with those knives.
Not true.
He does it with everything.
But it has
very volatile period.
So wrong, Phil. I enjoy your success. I enjoy Bill's success, and I wish you guys nothing but love and the best. Phil, by the way, Phil, I understand that you're going to get a little yard work done soon.
Speaking of making fun, I got some yard work coming up. I'm going. This is going to be most likely a 1-year thing. But I was told that we're having a graduation party, and there's to be no clovers or dandelions, and so I've got. And I think that's your fault because I don't know that Miss McCoy would have noticed. The clover and dandelion.
Phil,
until you pointed it out.
Yeah, the knife does not stay in the scabbard very long.
You went to another man's house and pointed out clover and dandelions?
No, he's never been to my house, John. I just heard him. That guy had mentioned it one morning, and he just starts tearing me up for not being a man. I wasn't taking care of my dandelions and clover, and I said, man, it's a lot of money to deal with that. And he's, do it yourself. And I was like, well, I don't have time to do it myself. I'm not very good at it. And he just keeps on busting me for having a bad yard. And my wife was listening to one day, and then she said, she's like, yeah, you know what? We're having people come over. I'm thinking, thanks. The first thing in my mind, thanks a lot, Rob. Thanks a lot.
I think you can file charges. You can file charges on a man code violation right there, buddy.
Phil, the front yard of a man says a lot about him. That's all I'm going to say.
Mine's woods.
Well, my front yard would say I'm very particular about mowing my grass, but I'm also a financial planner, and I don't want to put a lot of money into my grass, but until 2025, the summer of 2025, because Rob finally got me. He's got me.
Technically, your wife is the one giving the order on that one, Phil. So technically, but you stirred it up in the background. And here's what I would like to do is once it's all green and up to Rob's standards, you're going to have to come by now and give it the That's Rob's a deal. We'll give you the thumbs up.
So do you mow the crosses into your yard? Do you do the hash mark thing? Okay.
Yeah, I mean, I go different directions and put little checks in. It looks really good until, a couple days later, there's a dandelion that'll pop up. No big whoop, except for to Rob Mario. But I do have a loyal listener that's doing it for me. I know he does good stuff because I know him, and he's going to come out and take care of my yard.
Dow futures are down 520 points this morning. S&P numbers down 1.5%. That's worse than the Dow. NASDAQ, of course, the more volatile of the indices, it is down 1.8% this morning. Phil, now, I want to point out before we get into this kind of stuff that it was on this date in 2000 that the dot-com bubble peaked with the NASDAQ Composite Stock Market Index reaching 5,048.62, 5048.62. So if 25 years ago, you were 25 years old, and you put a bunch of money into the NASDAQ in the year 2000. At its peak of 5,048, it later fell to around 1,000, if I remember. As time went by, you still would have quadrupled your money because even today, with the horrific performance of the stock market as of late, it is still just under 20,000, Phil. And that means a 4 times multiple on your return if you just invested, let's say, in an index, maybe QQQ for the NASDAQ, and just let it ride for 25 years and didn't worry about it.
Yeah, and it's, right now, and it's easier said than done, but we're trying to, one of the things that we would say, if you said, well, hey, what do you guys do for people? For a lot of people, it is the discipline to know and acknowledge what you had just said, in itself, that these periods, although, there's a lot of emotion that is revolving around this most recent drop and a lot of fear, and it always does, to keep your emotions in check and don't apply emotional responses to your money because of exactly what you just said. Now, and one thing that we do in financial planning, for the more aggressive investors, we apply the rule of 72 that essentially says your money's going to double every 9 years if you get an 8% return, which is still kind of conservative. Well, based off what you just said, that's exactly correct. And you're going from the top of a bubble and to where we are right now. So that does play out in the worst of times. And we've had some really bad periods over the last 25 years. And this isn't even a blemish on to this point anyway. The NASDAQ is in correction territory. The S&P is not there yet, but based off of overnight trading, which certainly we've seen in the last month or 2 months, that you can't really parlay that out toward the end of the day. But the S&P is on its way, so that we're seeing some weakness in the markets, and there's a lot of reasons why that's occurring. But the biggest reason, in my opinion, is uncertainty. It's not necessarily the tariffs in themselves, but it's the uncertainty of what new policies will bring and how do we react. We've long said that companies will win the war and they will win the game and make profits if they know what the game is. And there's some confusion right now of what the game is. So as soon as there's some clarity on what this game may be, they'll win the game eventually. And, it was just over on Friday, I was talking to an advisor, not an Amirius Group advisor, but one that is looking at potentially, so a college student looking into coming into the field. And I said, I gave him a little homework. I said, find me a period over a 10-year period. Pick the day, and maybe I'm wrong. I'm just coming. This is coming off the top of my head, but find the day and move it forward 10 years. And if you can find any where the S&P, which I think is the main index, is negative. So a 10-year rolling window, find any day where that 10-year ended up lower than what it started with, and I would be shocked to see that were the case. And I'd go even further and almost say 5-year period. I could be wrong on the 5-year. That's getting a little bold, but a 10-year period. So because of that reason, that's why we preach this diversification and spreading your money out amongst asset classes for those that's relying on their money. So if you're in retirement and you're using your portfolio for distributions, it all shouldn't be in stocks. You should have some cash, and you should have some bonds, and you should have some long-term investments, which would be stocks. So if you're using your money, yes, then you should have some protection from this by way of cash and bonds. If you're not using your money, if you're 20, 25, 30, 35, and you're saving for retirement, in most cases, you should have the pedal to the metal, but knowing that this too shall pass, and it is but at a very emotional time, and trying to get people to look past their emotions and kind of put blinders on when you consider money decisions is difficult when there's so many emotions flying.
This one is a little bit different because I think a lot of this drama is self-created. But this could also really end tomorrow. If Trump changes his mind on tariffs, this changes the dynamic of everything like instantaneously.
But, excuse me.
It does. And there's brighter days ahead as far as policy decisions, and I'm talking about the market, so maybe you disagree with some of the things that could happen, but deregulation is typically good for our overall markets, and as well as the continuation of the tax cuts of 2017, and maybe even deepening of those tax cuts. And maybe you disagree with those policies, but they do tend to raise their markets overall. His first term, those tax cut was a huge catalyst in how the stock market performed. And that's on the agenda, and it's being talked about, and how those may play forward. And whether or not you agree isn't really the point. It's what impact it has on companies' ability to make money and consumers' ability to spend money.
But picking up on what you said, Rob, I think it was initiated by President Trump and his threats of tariffs on and off. But my sense is it's kind of migrated and moved past that. We've heard the new Prime Minister of Canada saying we're going to raise tariffs regardless what the U.S. does because of what they started. We've seen the same thing with China. We've not seen that with Mexico just yet. But my sense is that at least two of the three countries are going to be taking the action as opposed to waiting for the action. So I'm not sure we're totally in the hands of the vacillation, if you will, of President Trump.
But don't you think that if I should say the word is
Yeah.
if he changes his mind on tariffs, the nations that are doing the tariffs back at us will also eventually change their mind because we know from the Smoot-Hawley Act. Yeah. It's not a long-term winning strategy for global trade.
No, I agree with you, and you're right. They probably will, but that doesn't appear to be President Trump's way to operate.
Not at this time, no.
Well, he didn't the first time either. He wants to be in the headlines, be it COVID, be it the tax cut, whatever the case may be. He wants to be viewed or perceived as influencing all the direction, all the power. So as long as he's perceived of on again, off again tariffs, I don't think you're going to see either China or Canada relaxing what they're planning to do.
Well, he is president of the United States. So of
we
course
know that
he does want to be in the headlines.
Well, but not to that degree, John.
I pulled up a chart of it happens to be the Dow. I'm confident if it was the S&P, I see the same thing. The slope of it kind of looks like an EKG, right, with all the peaks and valleys over the course of the last, actually this looks like maybe 12 years of performance. And you can see what the daily discussions would have been. You see a giant drop from a 30,000 Dow to about a sub 20,000 Dow that's the day of COVID, right? But it looks like it was 2012, probably 13,000, give or take. And now we're at 42 and change after a high of 45,000. I remember getting a book from my financial advisor, from my accountant sometime around probably 2005, 2006, that just said, is it possible that one day there will be a 20,000 Dow? And this is when we were dancing around 12. And it's my approach to all of the markets is I'm kind of a buy and hold guy. Mm-hmm. I think it's frightening for new investors now to do the market timing. Is this the right time? And the answer I have always thought is yes, because you look at the slope. It is a consistent 45 degree. I mean, it's
over time, it will go up.
Over time, and it will grow up. It goes up substantially. If you go up, go back 20 years, you get the same slope. It just there are daily moments of terror, but normalized, it's a very satisfying slope.
Phil.
Yeah, and I'm glad he said that, because if you do look at the movement of any of the major indexes, what we've seen so far this year looks normal. And I don't think it's normal, but because it's for different reasons than what we've seen in the past. But it does look normal, and it's not even a headline yet as far as the market, the market weakness that we've seen over the last few months, especially February, and then last week was extremely volatile. But it's just it's the unknown. You know, we've spent so much time talking about the passive inflation in the Federal Reserve and the jobs number, and good news is bad news, and this just took the headline. It just basically took the headline because none of that matters as the waters are cloudy for the Federal Reserve as well. So we're looking at all this information, and now when a fear of growth in the past, and 6 months ago, was a good sign for the markets because we knew what was causing it, and we thought that the Federal Reserve could fix that. The Federal Reserve can't fix the weakness that has been brought on by the fear of tariffs and retaliatory tariffs. So they can't repair that. So what is their reaction to it? They can't walk in and save the day for that. And that's just creating a lot of fear, as well as new capital investment from companies right now. They're going to hold off on that, not necessarily due to tariffs, but because of a new president, period, and waiting for what are the rules before I put in long-term capital investments into something. I just need to know what the rules are. And we're seeing that play out right in front of us. And as well as like what you guys had mentioned, it is the belief that if Trump backs off on the tariffs or stops the tariffs or slows down the tariffs, those retaliatory tariffs would do the same thing. And it sounds very arrogant, but because we are the United States, and they do need our economy really pretty much more than we need theirs.
Phil, what about the layoffs or the reduction of the federal workforce? How much is that going to play?
I think it's going. I mean, and one, the fear of it and the stories that we hear of it are playing a huge role in our consumer confidence. But when you look at the numbers from it, it's going to hurt consumer confidence. It's going to slow consumer spending, but on a much smaller scale than what you would think. It will be a small scale injury, and then the next thing, and I don't even know how if they will track this, but those that are leaving the employment of the federal government, what are their rebound jobs? Are they going to seek or obtain employment that may be better? So in some cases, it will be. They may find employment that is better than what they had, higher paying, which enables them to spend more money. So all that will play itself out, and I don't even know that it will be tracked. But it does play a bigger part in consumer confidence and how we feel about our money and consumers as a whole than what it actually will with unemployment numbers and the likes when they come forward.
More people are talking about the R word now again, Phil, and that is the word recession. We have about a minute left. Any thoughts there?
And the reason that they're talking about that goes back to what we had just said before. There's a scare in the form of growth because the Federal Reserve can't save this. So if we're slowing down due to some of the policy decisions or some of the uncertainties of the policy decisions, that's not something that can be repaired by the Federal Reserve. And so therefore that word recession is going to pop back up. Whereas 6 months ago, slowing growth could be repaired and we could be encouraged to spend money by cuts from the Federal Reserve. So that's why it's starting to rear its ugly head yet again.
Is the Fed in a wait-and-see mode right now?
Yes, absolutely. They're waiting until, I don't know if they'll give us clear direction when they speak. Jerome Powell's really good at of not tipping his hand, but they are absolutely in a wait-and-see mode to see what these tariffs will be long-term. Not necessarily short-term, but long-term.
How do we get in touch with you for more information today, Phil?
You can reach us, DK Metcalf, at 304-263-4343, or stop by and see us with an appointment at 1270 Winchester Avenue right here in Martinsburg.
Thank you, Phil. Have a great day.
Thank you, guys. Appreciate it.
And catch 2 minutes of Phil every morning at 6:38, replayed at 7:38 for his views on the previous day's market and what's coming up that day, too. This is Talk Radio, WRNR Martinsburg.